Good morning and good evening, everyone, and welcome to another episode of Refinitiv Perspectives Live. Today we will be speaking about the new gold standard of wealth management, together with three of our guests, who are Alexis Calla, former global head of advisory at Standard Chartered Bank, also Steven Carroll, global head of sales strategy and execution for wealth at Refinitiv, and also William Ferrand, global sales strategy and execution for wealth at Refinitiv. Welcome, the three of you.
Great to be there.
Great to be here.
Good afternoon.
Thank you for joining this episode. I mean, we've got, I would say the best combination to discuss wealth and the new gold standard, as we defined it in the title. And I would directly like to start with the report that we are talking about or that we're referring to. And can you give us a little context on why Refinitiv have released the report and what was the background? Maybe, Steven, you can start giving us a little overview.
Sure. So the report we felt would be very important to understand in detail what is the impact of COVID on the digital landscape for our wealth customers. So clearly, as we've gone through lockdown, their customers have spent a huge amount of time using their tools in a different environment. Now working from home, no longer the perhaps more traditional kind of mobile interaction, and we wanted to understand how is that impacting individual investors. What changes are they seeing? What are they happy with? What are they unhappy with? And we thought it's great context for our customers to make sure that they stay current with kind of latest expectations or preferences from individual investors in the market. So it's a global report. It's just over 1,000 investors in all key markets across Asia and Europe.
I mean, and looking at the report, the low levels of loyalty for some investors probably seems surprising. I mean, what do each of you also think investors are looking for that they're probably also not receiving at the moment, or what do you think they're maybe even doing wrong?
Yes, I think in terms of the low levels of loyalty, there's potentially a generational thing. When I first read it, I thought, reading a lot of the European perspectives, that it was maybe us Europeans being quite pessimistic because we had low levels of loyalty and we like to complain about things but then not necessarily do much about it. You often see lower net promoter scores and things like that in Europe, but it actually made me think, and I think
maybe my view as the
the ease of changing means that it encourages that low level of loyalty. In the last year, I've changed current account, I've changed savings account, I've changed my online broker. So I think it's the fact that it's so easy to change that makes that low level of loyalty. But yeah, Alexis, sorry, you're about to start speaking.
Yeah, no, I think as the practitioner, I may have a slightly more positive view of the report. The way I read it sometimes is think of it like 6 out of 10 people actually feel equipped with the data and the content, to make the right decision. I think the same, there is if you look at webinar, you could say, 1% out of 3, do not find them useful, but you could also say 2 people out of 3, would find it useful. So I think, we could always look at the data both ways. Sure, there is some gap, but there is also, clearly some good development. And I think if I looked at Asia, the wealth management industry actually has significantly invested in building better digital proposition. And I think the pandemic has just been reinforcing that trend somehow. I think if you think of the stuff that was almost impossible 18 months ago, mobile access to portfolio, video conference, webinar, mobile chat, actually, many of the players, at least in this part of the world, are offering that. I think one of the challenges initially was that many people as well were looking for, COVID-related data. But the problem is that those data simply, didn't exist at the time. So people were saying, what's happening, what are the consumption in the restaurants, how many people are actually, getting infected, all those kind of stuff. It simply didn't exist. So this said, I think what the report seems to say is that, hey, and people echo that with the hyper personalization of the information, of the service, we tend to receive now as individual. Think of the unbundling of the information, you get on your mobile, the constant update, create kind of a theory expectation. And I think the wealth management industry, in general, it's fair to say that we've been lagging actually in following up there, and people being locked down have just realized that. And I think also probably COVID has actually triggered a new interest in managing money. Many people didn't really think about it, but suddenly being there and seeing the stress and everything happening, there is kind of a new demand. So there is clear challenge for the wealth industry. I think COVID has showed that, and the report is showing that. But I think it's also like everything, you have to be careful with information, and I'm sure we're going to discuss that. Is that it's kind of a mixed blessing, with information or more information. You could kind of sometimes reinforce the cognitive biases. Think of recency bias, confirmation bias of people. So again, I think a balanced situation, at this stage, at least in Asia, where I've got the most experience.
The report also says it all. It's changing the nature of the digital landscape that has happened over the past 1.5 years, let's say, or even a bit more. But it started to being pushed and being more efficient, more effective. It has to be for the new investors that we're seeing in the market, obviously. And you just talked about challenges. I think that's one big spot that we're also talking about, because it's not just about making those tools probably available to those new clients or changing the digital landscape, let's say, but it's also about what do we offer them, what else do they need, the data in itself. So the challenges, maybe we can also take that up. Where do you see the biggest challenge in that setup that we're facing now?
Shahad, I think it's an interesting question, because traditionally, I think digital firms had a very strong grasp of who their customers were. But as the lockdown initiated, they suddenly had this influx of new accounts being opened, and perhaps the background and the level of education of those customers might have been quite different to what was their traditional their traditional account opener. As a result of that, I think that there needs to be quite a reevaluation of whether, with this brand new cohort, all the tools are there, the education is there, it's clear how to use the product. I think this new group probably comes with a lower background in investing, and we've seen this new cohort also have some quite different approaches to how they invest, making reference to GameStop and to Reddit. So there's quite a lot of challenges for wealth managers to think about as they look at their digital tools in this new landscape.
Yeah, I think you made a really good point, Steven, on the education piece. We were talking about. I was talking to an online broker recently who was saying that they have to sort of keep things as simple as possible to attract the customers in the first place, but then it's part of educating them, giving them more information, giving them more data, so that they then stay there and don't sort of get bored once they've started. And you touched on the fact that the levels of knowledge may be different to what we've seen in the past. I think I read somewhere that one of the most used pages on the Robinhood app is their sort of questions and answers page, which has things as simple as what is the stock market, what is an equity. So I think you're right. It's really that sort of bringing people on a journey with them, so that you can start simple, but start to build things out more and more as they become more experienced and more confident.
I think we have to realize that nothing is going to be a one-size-fits-all, or nobody should try actually to come up with the universal solution. There is many different personas, different people, and they have different needs, and there is various ways to engage with them. And usually people say you have a very strong value proposition if you're not trying to answer absolutely every needs of every single person. So I think what we're seeing actually between the incumbents, between the new players, And that's thanks again to the new technology coming, regulators actually, being very open, and suddenly new solutions are being offered to new groups of people, and that there is kind of a learning phase, and it's true that historically, the world was relatively simple. Either you had access or you didn't really have access to solution, and when you had access, you had either access to a very powerful tool, called the human being, that was there actually to, personalize everything and makes it easy for you, to discover investment or invest properly. Or you would be someone who would say, I know enough and I would just go and do that myself. And I was more the brokerage model. And now things are different because there is many people who may want to access actually that human being, but they can't. Are not necessarily satisfied with the direct model, and you could see that as a real challenge, or again an opportunity in the current environment because of everything that is now possible that was not possible. Think of access to the data, machine learning, things about new models of communication, everything you could have on the mobile now. Just the bandwidth available for that. So I think it's also very promising somehow, and opening some very interesting new avenues for the industry and for the
Alexis. Do you think that's a little bit too positive? I'm just looking at the exec summary, and the first point is 39% of investors do not feel equipped with the data necessary to come to their investment decisions. And I know you're going to say, well, 61% do, but if we look at that 39%, that does seem to me like that's a very significant minority.
No, I think, well, you're right. I'm not saying the situation is rosy or perfect. I think my optimism is more about, what will be possible, or what is being built, as opposed to, the current situation. But, and true, somehow, if you want to play with number, the good old rule in the industry is the famous 80-20, essentially, your 20% best client tends to receive, 80% of your effort, and they also generate 80%, of your revenue. So that kind of dynamic actually means there is many people who potentially are left behind. You also have the challenge, in many parts of the world, is that in a model actually that was essentially a human, based model, the industry didn't have the number of people or the number of skilled people, in every location, every country actually to deliver, what people would expect. So I think what is being accelerated these days is those ideas of, not everything has to be done by a human being. There is actually a more hybrid model where, data and tools and everything, could also be part of the relationship, or in some cases actually be the core of the relationship for people who still want, the information to be digested, organized, who wants to have a way of communicating, but don't necessarily need to talk to someone. So again, my positive views is more about the realization by the industry, of what they could do. The fact that actually there is many enablers for the industry to actually start doing better. And the good news as well is that there is a big demand there. We've seen that because people are getting a lot more concerned and a lot more engaged, than they used to be, for their investment. And again, your report has some data on that. People are doing more and people are asking more. So an old challenge was, how do you activate people? Now we have many people who've been activated, who've transformed their latent needs actually into something they are aware and concerned with, and again, that's going to create a demand and the possibilities for incumbents or new players, to come and answer those questions.
I mean, picking up the challenge that we're facing and what you just said, these diverse needs of the customer base. Looking at you, Steven and William, I mean, how do they meet the diverse needs of the customer base? I mean, you have some customers who are very trading and short-term focused, I believe, others with low turnover, long time horizons. How is this being balanced? Maybe, Steven, you can start.
If I take a more Asia lens to that, I think it's very clear in the data that there is a significant trading mentality in parts of the Asian market. A lot of wealth here is first and second generation and more hands-on, and so the Asian wealth providers need to recognize that and need to provide quite a diverse array of tools. As Alexis said, one size can't possibly fit all. And where I find the digital platforms that perhaps let people down slightly is in not making clear which analytics and which content sets are particularly useful in which investment context. If you are this new generation of overnight day trader, focused on US markets, valuation is entirely irrelevant to the style you're adopting. But of course, I suspect some portion of this investment community doesn't even know that, wouldn't know whether or not value is correlated to short-term performance, long-term performance, or anything else. So I think that it's incumbent on the wealth providers to just do a better job of making clear amongst all of the vast amounts of content that they have on their platform when different parts of it are relevant to an individual investor. And I think that takes us back to the first point, that with this new influx of this newer, younger cohort, that there's more work yet to be done.
I also think the point Alexis made about hyper-personalization, but understanding who your customers are, whether you're targeting more of the investors or more of the traders. And I think one of the things that came out in the report was a big ask for alerting. And if you think about push notifications on phones, I get notifications on my phone saying Bitcoin's up 5% or something, and it's really that sort of prompting people with ideas to trade. And Bitcoin's up 5% is a pretty clear one of what they're trying to do, but some sort of more subtle, I guess, notifications and alerting, around news, around economic events, around lots of different things that might actually push people to get back onto the app and start using it again.
That takes us a little bit down the road.
Yeah, please.
Sorry, Shahad, I was just going to say, and that kind of is a kind of a light push in the direction of gamification, making it more enjoyable for the trader. And of course there are mixed feelings on whether that's a good thing or a bad thing. But I certainly agree that alerts, if you're a wealth solutions provider trying to encourage greater engagement, alerting is one of those areas that I think has been underinvested in.
If you could trigger, greater engagement, actually, the proper way, that create massive opportunities, actually. I think that the challenge is, a lot of the new technology, actually, and what we experience with every day is that it tends to be, habit forming, kind of solution, and they kind of hooked us on, them, and we have to go every day and trying, to get even more actually out of them. And when it comes to investing, there is at some point actually it could become too much. So that's the risk. How we're going to balance that? How we use the good aspect of it, which is people are actually more engaged and potentially more responsive to suggestion, to ideas. And how do we make sure we don't transform that into actually that's something that is detrimental, at least for some of those people. So again, it's kind of a mixed blessing, all that new technology, and we're all going to have to adapt if we want to make sure that ultimately we create good outcomes for the investors.
We have one question from the audience that fits into this conversation before I would like to jump to trends. It's about your thoughts around the traditional long-term investors versus the more arguably millennial approach, let's say, of short interest investing. You've all mentioned a little bit about it, but your general thoughts, what are they around this? Before we jump to trends, which will lead then to exactly what you're going to say now.
So my argument is short-term investing is an oxymoron, right? Let's call it what it is. It's speculation. So, that's a function of how engaged people want to be in the market and their risk appetite. But long-term investing is buying an asset and watching it appreciate over time, hopefully a mispriced asset and doing well. Whereas, what's going on at the moment is just momentum trading and reminds me a great deal of the late 1990s. So, I don't think you can compare and contrast the current millennial approach with long-term investing. They're different things attempting to achieve different goals. One's just another form of gambling and speculation, and the other is wealth building. But Alexis is the practitioner here. I'll let him add to that.
Maybe I think there is we need to realize the context actually of that younger generation. I think if you think of it, every generation at some point starts realizing that, hey, it may be time actually to pay attention to my finance. And I think in the context of the younger generation, because of COVID, suddenly that need has been kind of accelerated. Suddenly, people were locked down, as we said, potentially they had a bit of money, they had plenty of times, and it was a very stressful environment. Say, what's the future going to be about? So that's kind of, you have, a need for something, and then you have that catalyst. And I think there was also a few things around is that if you think of it, free access to more data, first generation to have free access to data. Free trading of equity, first generation to have free trading for equity. Fractional investing, first generation. Thematic investing, we have many names, first generation to get that. That notion of gamification or that culture of gamification, first generation. So suddenly, very, very short, time period, people realize, and then when they looked, around them, they say, oh, there is a lot of stuff directly available in a format we knew, mobile, digital, and free. And I think, suddenly that's why, most of that need, somehow got channeled actually to trade, what we call trading, because that's the first experience they had. And if you think at, what other generation were looking at as well, think of bond and all that kind of stuff, pretty much, they are paying pretty much nothing. There is none of the free access, free trading, fractional investing available there. So I think that also explains a lot, what's happening. But like everything, people will try, people will learn. Are we going to get, something as the bubble of 2020? Are we in one of them? We have to remember that for that to happen, it means every generation somehow, got into the bandwagon and the wagon, and then the diversity in the market somehow collapsed. As long as, you still have a balance between, institutional, between, baby boomers and between the new joiners, we could have a very dynamic market. It doesn't mean it's going to end up in a big bubble. But again, I'm not blaming the new generation. I think, they've just realized they needed to do something in a very unique environment with some very unique tools. And like everything, they're going to have to learn about that. And that was not really the case, actually, for the previous generation, or at least not to that extent. That would be my view there.
I think you made some good points, and on Steve's comparison with the 90s, I read an amazing stat that in the 90s the average day trader was 50 years old and had $47,000 invested, and nowadays the average day trader is 31 and has $3,000 invested. But I think since this sort of boom we've seen over COVID, the markets have been going up, everything's been quite positive. So to your point, Alexis, are we seeing a bubble? When you always hear, oh, this time it'll be different. And I speak to a lot of my friends who say, oh, well, no, once things open up, money may flow out of some of the tech stocks and go into as airlines and entertainment and things come back, or as we look into sort of some of the more sustainable investing that we can get onto later. But we haven't seen, people have been making money, so that sort of is going to build the interest more and more. So I just wonder if we do see a correction dip, whatever we want to call it, will people lose interest, if they lose their money, or are they here for the longer term?
I mean, thanks for your views on that, and picking up the question from the audience. It's always really interesting to get a spontaneous feedback also. And I myself, I count to those millennials that started trading. I mean, given the opportunities that we're getting, the offers, you can start with very, very low content of money. You have all the data that they are like throwing it right into your faces, and the options that you have, they all seem very attractive. So I think that's also what's pushing a much younger generation to just try without having that big of a risk, because it doesn't feel like it's super risky. But in the end, as you said also, Steven, it's speculation more than it is really investing at that point. So it will probably be very interesting on where this is going. And in terms of where this is going, I would like to ask you a question about the coming trends in the industry, because I believe there's also, well, you probably know what's going to come up. That's one big thing that everyone is talking about. So in terms of trends in the industry in general, one that emerged very clearly also in the report was around ESG. So when we see a big interest in ESG across the board, it has increased significantly through the lockdown also. And unsurprisingly, mostly focused on millennials. So how do wealth providers meet this need? And is this the new normal, in your opinion? Do you think it is fully structural or partially cyclical?
Well,
maybe we can start, please.
Shahad, I would say that this is a structural change that will. It's supported by so many different drivers, right? It's supported by regulatory drivers, by the interest of this younger generation, by constant coverage around climate change. And then, of course, we're seeing increasing quantities of data that just prove that ESG investing doesn't harm your returns and may, in fact, on a risk-adjusted basis, lead to outperformance. You tend to invest in lower volatility and better managed companies. So I certainly feel that it's a long-term structural trend. In terms of how wealth management companies offer this to their customers, certainly we're well advanced on that process. I think in the report, 40% of millennials already own a product of some type in the wealth management space that is ESG related. So adoption of that generation is fast increasing. It's well ahead of older generations. But of course, those older generations have probably held their mutual funds in most cases or their equities for a long time before there was kind of widespread product availability. So, I'm certainly bullish on ESG as a new driver of returns and as a new way in which to measure risk. And I think it's really exciting to see what's going on in the market. Certainly, we're seeing huge demand for our ESG data and analytics, which is just a direct response to the demand our wealth customers are seeing from individual investors.
I think this time I would echo actually, Steve. So I think when it comes to the social preference, for sustainability, it is clearly structural. I think with COVID, all of us have realized actually somehow the fragility of many aspects of our current model and the fragility of the environment in which we live. I think from a culture as well, it has somehow accelerated the realization that, the old model of a maximization of profit at all cost, of gratification, was reaching its limit. I think in terms of enabler, and that's all about the reports, data now are making it easier to track. There is intellectual frameworks, being promoted and being, worked out so that actually we could think about ESG, in a better way. But if I see, again, that social preference as structural, maybe the investment preference. So it is people, going into ESG assets. I think we're going to see some cyclicality there. You always see that. One of the reasons is that if you look at some of the recent success of ESG, it's not just about ESG. It's also because, growth tech companies tended to be associated to ESG. They've done a lot of better, in the old environment. So if it is some kind of a rotation in the market temporarily, we might see on a short-term basis, some rebalancing and some rebalancing of that investment preferences as well. I think the question on, and we emphasize, the appetite of the millennial. I think actually it's across the board. I think what happened as well is that the millennial, as we were discussing, or the younger generation have really started going into investment. And when we see, why are they more about ESG? Simply because they are more into investment and they are also more into ESG. So that kind of a compounded effect, may explain why you see the difference. But other data, I had access, seems that the older generation are actually, very close behind the millennials with those concerns, usually, no more than 10% away. In terms of the needs of the investors, and as we said, availability of access to data, education, this is going to be really, really key. And I think this is really well documented in the report. I would add as well that, personalization, again, could play a role. think of personalization of the goal, personalization of the product, the reporting, the way, today the industry measure portfolio performance, all that stuff actually, we'll have to adjust to actually reflect that new social and investment preference.
William, maybe you can add your view to this.
Yeah, I think, I echo a lot of what Steven and Alexis have said. I think there's potentially a bit of a divide between, those that are trading, sort of short-term traders and the investors. And I think the investor side, they've touched on very well. While I think people like sustainable investments, I think a lot of these short-term traders are going to be looking purely at the returns for now. However, when you have groups sort of getting together on Reddit to agree on what they're going to buy, maybe they'll say, well, look, this is a good company to buy, as we've sort of seen with Tesla, where they're sort of promoting electric cars. Let's all go on this one. So it could be a trend within the traders as well as the investors.
And I mean, in terms of the whole input that those, let's say, the millennials and the younger generation, the new people, it doesn't only have to be millennials. If we're looking at the input that they're getting, not only from the apps that we're discussing, not only from the websites and the financial industry, let's say, also from what's been the development of, well, the world around us, to make it the bigger picture. Do you see that this is has a side effect or a big side effect, or do you think that this is just moving more or less with the development that we see in finance? Alexis, you're nodding your head. Maybe you can say something to that. I mean, outputs. I mean, things like, let's say, new documentaries on the ocean and people making their minds up to invest more in the ESG sector, and then combining this with different things. Do you see that this has an effect, or is this something that you see more as an side information?
No. I think there is definitely a need. It's so complex as a question. There is so many ways of looking at it that I think, again, people today are getting more and more data. Some of those data are not fully aligned. That creates uncertainty. That creates, a need for engaging with other people. That create the need for, how do you organize those data? How do you make sure they are not biased? Actually, so I think there is a lot of stuff that are being created, new demands emerging. Just to help people make sense of those data. That's what we're, discussing a bit earlier as well. Is that depending on the kind of data you're going to receive and your initial actually perspective on the questions, you may end up again reinforcing some biases or everything. So there is a crucial need for helping people with those data, generating new tools, allowing them to ultimately end up taking better decision based on their value, but also sometimes some of their financial requirements.
Yeah. Probably it's also about the whole learning aspect, as I see it, because you all mentioned also that the education in regards of any financial investments or the financial sector, as William said, it's starting with questions like what is equity, what is the stock market, and explanations like that to start really from the bottom. I believe the learning aspect is becoming also bigger and bigger, and everything that every kind of data that we can put into those apps and websites, and any kind of documentary and explanation, YouTube videos to explain the stock market and things like that, are really helping to move this whole ESG trend, if we're really mentioning it, saying that it is a trend, to being pushed forward. In those terms, we have a question from the audience also around, let's say, ethical investments, because the comments at the moment are about the morality of money. Do you have any opinion on that, or can we, is this being moved into some kind of direction?
Yeah, I think going back to my point, a lot of the traders are there to make money, but I think there is, because sort of going back to what I was saying a minute ago with millennials sort of wanting to be more ethical. And if we look at what happened with GameStop, whether right or wrong, it was a lot of people that thought that short sellers were sort of being immoral, so they were almost trying to act as the police to push this away. So I think that as the two can sort of work hand in hand, that well-run companies that have a great future with sustainability and are going to help the earth are going to, in the long run, provide better returns, and they also will have help from governments and things like this. So I think that, yes, sort of purely making money doesn't necessarily always seem ethical, but actually that in the long run, investing ethically sort of will help you to make money. I may not have explained that so well, but I think the two sort of converge quite well.
Yeah. No, I totally understand. It's about the combination of whether the data that you're getting, the education that we're all moving into, and then how we use that, well, also for ourselves, and obviously to help and keep that ethical mindset to help not only the companies that we're investing in, obviously, but also ourselves, and then to feel good about the money probably that we're making around this. I think that's more or less the direction that the comments are about, or the audience that we're having right now. I have another questions. I mean, following up on the wealth providers, do you think they have the right tools in place now to support this new generation, to support this new movement, let's say? Maybe we can start with William or Steven from the perspective of also Refinitiv and what has been changed or what is changing.
I think Steven was
Yeah, I'd say it's a work in progress. Clearly, the answer is not yet. So I think if you look at ESG, I would say ESG data is not yet kind of prevalent across all digital platforms. So there are still plenty of providers that don't have an ESG solution. That probably helps explain the 39% that reply that they don't have all the the data and the tools that they need. And maybe there's also part of that represents other even more controversial asset classes such as crypto. So I don't think they're there. I still think that there is work to be done to understand what the appetites, requirements, expectations are from these younger investors, and then translating that into adjustments to their product set. Back to Alexis, there's also a cold, hard value calculation of whether these new investors, will be profitable, and adding this type of data and content will give the online broker or wealth solutions provider a positive return.
I mean, you also just mentioned. Sorry, Alexis, please.
No, I would say the same. Not the work in progress, but I think the good news is that there is two very important, drivers at the back. One of them, there is a clear need actually to answer those questions, and there is potential business model, attached to that. So it's kind of you have a demand, but an incentive to supply. And I think as a society, anyway, there is also a clear, push for those questions and those discussions to take place and to be addressed. So the combination of the two actually should force the industry, to go into that direction.
I mean, because I was just about to say, because Steven also mentioned cryptocurrencies. These are one of the other trends, let's say. So digital assets, cryptocurrencies, currency prices, they are in the news every day. What is the view on digital assets, or do you think that this is another structural trend? How do wealth providers meet those needs as well? Maybe we can start with this.
You asked a bunch of questions there, but is it structural, or is it a function of all of the money sloshing around? That I'm less certain on. Tools or data feeds are now available that can provide pricing data for crypto. but it's still a kind of nascent space, and I don't have a strong opinion on like whether the underlying driver here is sustainable or not. I'll pass on to others with stronger views.
Yeah, no, I think, when you look at a few things, there is always the scary one, and, you say, oh, Bitcoin is up again, 120%, something like that, year to date. We had Coinbase, I think yesterday, listing for 76 billion. There is the story of the non-fungible token, selling for almost, $70 million a month ago. But at the same time, if you look at the industry, there is the famous CFA Institute, that puts a pretty, positive piece on, crypto, generally speaking, at the beginning of the year. So I think to me, it's always a question of, trends are not linear. There is the very famous, I think it's the Gartner model for innovation. And I think there is if I remember, 4 phases, one is innovation. Then it's you have almost inflated expectations, and then things deflate, and then you're at the trough of disillusion, and then finally, you're on a proper, path. And I think if you look at a few things today, take artificial intelligence, or I think it went through the full cycle, and now it's something that is there, and people are have completely bought into this one. Maybe Bitcoin and blockchain, they are somewhere between 2 and 3, from the peak and the trough. Maybe crypto assets, they are in the first phase. But again, ultimately this will lead to changes. This will find its way actually into the investment space or the social space. And I think the good old advice is always don't just fall in blind love for innovation, but at the same time don't totally ignore it, and based on your appetite, how you deal with that. So that would be my take on them.
Thank you for that. I believe we have run a little bit out of time, so thanks everyone of you for joining this conversation, for giving us so many good and really nice insights to also think about. I believe our audience definitely will. I will as well. So thanks for joining. Thanks for your time, and I'm hoping to see each one of you soon.
Thank you. Thanks a lot.
Thanks everyone for listening. And if you enjoyed today's conversation, you can read the full report that we just talked about, the gold standard of wealth management, redefining investor data needs, by following the link in scanning the QR code that you see right now on the screen. Thank you. Bye-bye.